This video was brought to you by Incogni. Like transatlantic siblings, Americans and Europeans love to squabble. Americans mock Europeans as pretentious antisocial drunkards, while Europeans mock Americans as unsophisticated, jingoistic gun nuts who only eat fast food. But one area where Europe doesn't have anything on the US at the moment is the economy. While Europe's economy sputters along, America is roaring ahead, with rapid GDP growth, falling core inflation, and now falling interest rates. Unfortunately for Europeans, this is just an acceleration of a pre-existing trend. And while it can be overstated, Mario Draghi's recent report on European competitiveness made it overwhelmingly clear that the economic gap between the EU and US has been widening since at least 2008. So in this video, and in the spirit of optimism, we thought we'd take a look at 3 things the EU might be able to do to catch up with the US. Namely, increasing productivity, getting better at industrial policy, and nurturing big companies. Before we start, if you haven't already, please consider subscribing and ringing the bell to stay in the loop and be notified when we release new videos. Anyway, let's start with productivity. According to Draghi's report, European productivity, broadly defined as GDP per hour worked, has fallen from about 95% of that of the US in the 1990s to nearer 80% today. So what's gone wrong? Well, there are sector-specific reasons. European industry, for instance, has struggled with structurally high energy prices since Russia's invasion of Ukraine. Pipeline gas from Russia used to account for about 45% of the EU's natural gas imports, but this has obviously now been cut off, costing the EU more than a year of GDP growth and forcing the bloc to redirect massive fiscal resources to energy subsidies and building new infrastructure for importing liquefied natural gas. While Europe is now over the worst of it, commercial natural gas prices are still 4 to 5 times higher than in the US, and electricity prices are 2 to 3 times higher. Europe also isn't doing particularly well when it comes to tech, both in terms of generating new tech companies, which usually have very high levels of productivity, and in terms of digitizing pre-existing companies. In fact, the aggregate gap between American and European productivity has mostly been driven by a widening productivity divide in tech and professional services like finance, which benefit most from digitization. However, perhaps the overarching reason for Europe's weak productivity is the continent's weak investment levels, which lag behind the US. So the best way to improve productivity is to invest in stuff like technology and worker training, but Europe just doesn't do enough of this. So how do we remedy this? Well, this investment can either come from the public or the private sector. Historically, around 4/5 of productive investment has come from the private sector, but there's a growing sense in Europe that reaching the necessary investment levels will require more muscle from the public sector. Mario Draghi's report, for instance, called for a massive increase in joint borrowing to fund more public sector investment without forcing cuts elsewhere. Unfortunately for Draghi, this does look unlikely, thanks to both German opposition and a surge in anti-Brussels sentiment recently, which leaves us with the private sector. Inducing higher investment from the private sector is more difficult, but it's not impossible. One of Draghi's favourite hobby horses, for instance, is a so-called capital markets union, which would basically make it easier to move money across EU borders, thereby providing businesses with a greater choice of funding at lower costs and increasing investment overall. The EU could also learn from its own best performers. Germany, Finland, and Norway, for instance, all have high levels of private investment and enjoyed solid productivity growth post-2008. Now, there's some data to suggest that this is in part due to their corporate governance infrastructure. In these countries, workers are more likely to have equity or some kind of say in the running of the company, which might actually boost investment, because workers want to make sure that the company is productive enough to guarantee them jobs in the future. But the main thing that European governments can do to induce higher private sector investment are 1. Provide political stability, which gives businesses the certainty to invest long term, and 2. What's become known as de-risking. Essentially, taking on some of the risk for investments that are considered to be in the public interest to draw in private capital. Now, the merits of de-risking are contested. Some people think that the state would be better off just investing money themselves, but without more fiscal space, de-risking is sort of the only option. Anyway, on to the second thing, industrial policy. As you might have noticed, protectionism is on the rise at the moment. Multilateral institutions responsible for upholding the global trade order, like the WTO, are essentially defunct, and even countries like the US, once ardent advocates of free trade, are now aggressively subsidizing their favorite sectors. This means that the EU now has to take action to protect its companies from unfair competition from subsidized foreign alternatives, at least in strategically significant sectors. To this end, in June 2023, the EU adopted a new economic security strategy, but this has only mitigated rather than resolved Europe's competitiveness crisis, as evidenced by the continent's ongoing deindustrialization. Individual nation-states have taken more aggressive action to protect domestic companies, but a lack of intra-European coordination limits efficacy, both because individual governments can't protect entire sectors of the European economy, and because industrial policy doesn't work when your single-market neighbours pursue a different policy. For instance, there's not much Germany can do to protect its automotive industry from Chinese imports if Hungary lets BYD set up a factory next door. So if the EU wants to fix this, it needs to cooperate more on industrial policy and come up with a collective foreign economic policy, to borrow Draghi's phrase. Finally, the EU also needs to do more to nurture big companies, which is something that it's currently uniquely bad at. In the last 50 years, the EU has set up no company with a market cap over 100 billion euros, while the US has set up 6 companies, mostly tech companies, with valuations over €1 trillion in the same time. Europe also has far fewer active unicorns than the US, and Europe's big tech companies are both smaller and more likely to be in mature sectors like luxury goods or pharma. And this is bad, in part because big companies generally pay a lot of tax and account for a disproportionately high share of investment, but also because it's a symptom of deeper issues in the EU's single market. Funding is harder to come by at every stage of development, and a confusing tapestry of national and EU regulations makes starting a business more expensive and scaling businesses across Europe more difficult. More than 60% of EU companies consider regulation an obstacle to investment, and 55% of European SMEs consider regulatory obstacles their biggest challenge. Now, some of these funding shortfalls could be remedied by the Capital Markets Union we mentioned earlier, but the problems with scaling can only be remedied if national governments hand more regulatory powers to Brussels, and the EU becomes more efficient with its regulation. For context, the average EU law takes 19 months to actually pass, and that's excluding its actual implementation in member states. Ultimately then, none of these things would be politically easy, but they're not inconceivable, and the EU's increasingly acute economic slowdown might well push the continent into more drastic action than usual. Now, as we've demonstrated in this video, there's a huge amount of uncertainty in the world of politics and current affairs, often with very few easy solutions. Unfortunately, this can be the case online too. There are all kinds of bad actors out there who want to try and use you to make a quick buck. Take, for instance, data brokers. They collect, aggregate, and sell your personal information, including names, aliases, social security numbers, login credentials, home addresses, location history, online activity, and more, to the highest bidder. This can result in everything from spam to identity theft. Luckily for you, though, there's a solution: Incogni. They work on your behalf to request your personal data removal. They also deal with any objections, and to make sure that your personal information isn't shared by the data brokers again, they conduct repeated removal requests. And with their friends and family plan, they'll even do this for you and up to 3 of your, friends and family. So create an account with our link in the description, grant Incogni the ability to work on your behalf, and sit back as they make you safer. Plus, if you use our link, you'll get an exclusive 60% off an annual Incogni plan. Thanks for checking it out, and thanks to Incogni for sponsoring this video.